Hi guys, we'll continue with question 4 of the COMM 217 Fall 2014 midterm. We have a company that sells one product, and there's transaction related to this product, as you can see below. And it tells us that this company pays 40% of its inventory purchases with cash and the rest on account. And it uses the FIFO inventory costing method. And all sales are on account as well. We'll start with the first requirement. Assume Tuggers uses a periodic inventory system. Prepare the journal entries to record the transactions on September 4th and 11th. You must know that in a periodic inventory system, the cost of goods sold is recorded only at the end of the period. Therefore, on September, we'll start with required 1A. On September 4th, there's a sale of 80 units at $18 each. Therefore, seeing that all sales on account will debit trade receivable. We'll multiply 80 times 18 will give us 1,440, and we'll credit sales revenue for the same amount, 1,440. And this is from multiplying 80 times 18. Now for the transaction on September 11th, we have a purchase of 150 units at $16.50 each. On September 11th, seeing that in a periodic inventory system, every purchase of inventory we debit purchases. Therefore, we'll debit purchases for the amount of 2,475. This amount is from multiplying 150 times $16.50. And we will credit cash because they state that 40% of their purchases are paid with cash. Therefore, 40% times 2,475 will give us 990. This is and the rest is paid on account, therefore trade payable of 1,485. And this is 2,475 times 60%. And for part B of the first requirement, calculate the cost of sales for the month of September 2014. Part B, we'll make a table which will make it easier to understand and make less mistakes. On September 1st, we have beginning inventory of 100 units at a cost of $15 each, which gives us 1,500. And on September 4th, we have a sale. We have a sale of 80 units. And the only inventory we have on hand is the inventory from September 1st, the beginning inventory of $15 each. Therefore, our cost is going to be 80 units times $15, which is 1,200. And we'll subtract this amount, which would give us 20 units left at $15 each, giving us $300. And on September 11th, there's a purchase of 150 units at $16.50, giving us 2,475. On September 13th, there's a sale of 120 units. And remember, we're using the FIFO method. Let me just write that clearer. We're using the FIFO method, therefore the first inventory purchased are usually the first inventories sold. Therefore, we'll take 20 units from the beginning inventory. Therefore, 20 units at $15 each. Then we need 100 more units. Therefore, we'll take that 100 units from the purchase of September 11th. Therefore, 100 units at $16.50. This will give us 1,950 reduction in inventory. And we'll subtract everything, which will give us 825, and we're left with 50 units at $16.50. On September 20th, there's a purchase of 160 units giving us 2,720. And on September 27th, there's a sale of 100 units. And like I mentioned, the FIFO method, the first inventory purchase is the first inventory being sold. Therefore, we purchased these 50 units on September 11th. Therefore, we're going to take 50 units from here. Therefore, 50 times $16.50. But we need 50 more units, which we're going to take from the purchase of September 20th. 50 more plus 50 times $17 per unit. This will give us a reduction of 1,675. Now we're left with 110 units at $17 each. These are the units that were purchased on September 20th, giving us a total of 1,870. This is our ending inventory. And if we go to the requirement, is calculate the cost of sale for the month of September 2014. Therefore, our cost of goods sold will be the sum of the cost of every sale. On September 4th, we have a sale, and the cost is 1,200. On September 30th, we have a sale. On September 13th, a sale here. September 13th, another sale of 1,950. And on September 27th, we have a sale of 1,675, which gives us a total cost of goods sold for the month of September, 4,825. And for Part C, prepare the journal entry or entries to record the cost of sale at September 30th, 2014. seeing that we're using the periodic inventory system, at the end of the period, we have to record cost of goods sold, ending inventory, beginning inventory, and purchases. This will be done the following way. We'll debit cost of goods sold. And we've already determined this amount, which was 4,825. Therefore, debit 4,825. And we will debit ending inventory. The ending inventory we have already calculated the previous problem, which is 1,870. 1,870. Now we will credit beginning inventory for 1,500. This 1,500 was from the previous question as well, 1,500. And finally, we will debit purchases for 5,195. This can either be a plug-in number from subtracting the 4,825 plus 1,870 minus the beginning inventory of 1,500, or you can add up all the purchases we've made during the month of September. Now we'll continue with requirement 2. What would you do differently for items A, B, and C of requirement 1 if Tugger used the perpetual inventory method? In order to answer this question, you must know the difference between the perpetual and periodic inventory system. Therefore, I'll make a small table to help you students visualize the differences and similarities. Perpetual and periodic. For perpetual, the inventory is updated after every transaction. And for periodic, inventory is updated at the end of the period. This is a difference. And when you purchase inventory for perpetual system, you debit inventory and you credit trade payable. And for the periodic inventory system, you would debit purchases and credit trade payable. This is another difference. At the sale of inventory in the perpetual system, you will debit accounts receivable and credit sale. This would be the same for the periodic system. However, in the perpetual system, you would also have an additional entry of debiting cost of goods sold and crediting it inventory. This is done because we're keeping the inventory account up to date after every transaction. And for the periodic system, there is no entry. And at the end of the period, there's no entry in the perpetual system because we've already kept the inventory account up to date with our previous transactions. But for the periodic system, we're going to have to make two entries. of cost of goods sold debit will also debit ending inventory and we will credit purchases and credit our beginning inventory. So this is another difference. As you can see, there are many differences with the perpetual and periodic system, but the one similarity is the entry of accounts receivable and sales for the sale of inventory. Now we'll go to the third requirement. Target uses the lower of FIFO and net realizable value rule on an individual item basis. The net realizable value at the product is $15 per unit at September 30th, 2014. Inventory must be recorded at the lower of cost or net realizable value, and our cost, which we calculated in the first requirement, is $17. That's our ending inventory cost. And the problem is stating that the net realizable value is only $15. Therefore, if the cost is greater than the net realizable value, we must have a write-down. And the following entry for write-down is the following. I'll just erase these. You guys can pause the video and note these down. So for the third requirement, the entry will be to write down the inventory will be debit cost of goods sold for 220 and credit ending inventory for 220. And we get this 220, as I mentioned, our cost was $17 and our net realizable value is $15. Therefore, 17 minus 15, this we have to multiply by the number of ending inventory we have, which is 110. Therefore, times 110 will give us our 220. So that's the journal entry for a write-down of inventory. And we'll go to part B. Assume that the company's accountant ignored the lower of cost or net realizable value rule. How would this error affect the company's inventory turnover ratio and its current ratio? Therefore, for B, the inventory turnover ratio is calculated as the following. Cost of goods sold is your numerator, and your denominator is your average inventory. Therefore, if we didn't make the previous entry of the write-down, if we didn't debit our cost of goods sold, our cost of goods sold will be understated. Understated. And if we did not credit our ending inventory, our average inventory would be overstated. Therefore, if our numerator decreases and our denominator increases, this ratio, this following ratio, the inventory turnover ratio will decrease. And for our current ratio, the calculation is our numerator is our current assets, and and our denominator is our current liabilities. And in the previous entry, we credited ending inventory. If we had not done that, our current assets would be overstated. And in this case, our numerator is increasing while our denominator is staying constant. Therefore, the ratio would increase. All right, thank you for listening. If you have any further questions, please ask your professors. Bye.